This is a presentation on practice inspection, and CPA Manitoba has issued their annual report on issues they found in practice inspection. And I always say we want to be efficient and effective and follow professional standards and document what we have done properly. And in particular, their observations are about where we have not followed professional standards. So I find it useful to review this just in case in our firm we're not doing it right. And I also like to look at the places where they have documentation suggestions. So with that, I'm going to go through what they recommended. Now I'm going to skip the accounting issues. I just want to talk about the audit issues, but I've briefly gone through that, and it looks like it's a good list of accounting issues we should check to make sure we're following. Now they identified 23 audit issues, or at least there are 23 paragraphs. I'm going to treat each one as a separate audit issue. Now of the 23, 11 can be fixed by better documentation. So the solution is a better checklist with a prompt that reminds you to do those 11 things. 2 are mostly better documentation with some underlying performance. And again, checklist prompts. 2 are more performance that needed to have been better documented. And again, checklist prompts. And 8 were purely performance deficiencies. You just have to do those. Now, my concern is particularly the 8 performance deficiencies, because I would want to check at my firm that we weren't doing any of those things. For the other 15 that are documentation, I guess I would want to check my documentation, standard documentation requirements, to make sure that we have prompts to remind us to do all these things. Now, I dislike an audit being done for the purpose of producing pretty documentation. The audit should be done for the purpose of identifying material misstatement by doing procedures, performance. And I worry a little that we are producing pretty documentation at the expense of performance. Performance should be our first objective, and we need to find a simple way to document it as we do the required procedures. Now, standards suggest simple documentation. A number of places they say this can be done simply. And for instance, 230A7 says the existence of a planning memo satisfactorily documents planning. And there are a couple of other suggestions in that paragraph. You might take a look at them. Now, some people like a long memo, 2-page memo about something. There's nothing wrong with that, I suppose, if you wish to spend the time every year to write the memo. My concern is I often see those memos being carried forward without being updated, or a nice-looking memo on subsequent events being taken from one file and inserted into another without anything actually being done. So I don't like long memos, and they're not required. And actually, if you look in standards, the only time they suggest a memo is when there's some issue that needs to be dealt with. Otherwise, they kind of say, you're okay. And checklists are okay, and indeed they're suggested, and I've got another module where I talk about that in detail, so if you want proof of that, you can go see that module. Point number 1, documentation of risk assessment procedures. And they refer to 315.19 through 27. And in particular, they talk about documentation of internal control did not include the entity's information system and communication relevant to the preparation of the financial statements. Now that's actually in 315.25. There are other items that are mentioned in 19 through 27. But as I said before, A131 says this can perhaps be done simply by inquiry. So there's a suggestion about how we could do that, and maybe a checklist suggesting I inquired about that and it's all okay might be satisfactory in the circumstances. Now, I do kind of like checklists, And to be picky, 315 only requires documentation of 19, 21, 22, 24, and 25 in Part B, and in C, 26. So 20, 23, and 27 need not be documented. But I kind of like the idea to have a checklist prompt to prompt me to think about the things in those 3 paragraphs, even though I don't have to. I certainly want prompts for the first set where we have to document it, but I kind of would like the last 3 as well. Now, we can provide simple documentation, and we can solve this particular problem that they're mentioning through documentation. But for an example of a checklist prompt, paragraph 27, don't have to document it, but it says, based on the auditor's evaluation of each of the components of the system of internal control, determine whether or not one or more control deficiencies have been identified. Now, 315 doesn't require that we document that. I kind of think it's an important thing. When we get to 265, which talks about communicating significant deficiencies, it says we have to communicate significant deficiencies in writing, and hence we document them that way. So even though it's not required, I would kind of like a checklist step or prompt to say, based on my understanding of the entity and its environment, 1, I did not identify control deficiencies significant to the audit, and 2, I did not identify significant control deficiencies that need to be communicated. And at point 1, I'm being kind of clever because I could have identified insignificant deficiencies, but I don't care to talk about those. They're insignificant. So I document that I didn't identify deficiencies significant to the audit, and then significant enough that need to be reported. You might want to have in your checklist a B, or if I did identify them, I described them on such and such a working paper, just because now often there will be nothing identified. Occasionally something's identified. So you'd like to have your checklist prompt respond to that and to allow you to produce a bit of documentation to describe what you found. So I kind of like a checklist prompt for that. Documentation of management's knowledge of fraud, 240.18 through 22. And we have to ask management about actual or suspected fraud, and management's process for identifying, and we have to contemplate talking to those charged with governance as well. Now, I think this can be dealt with by documentation, by having 2 standard representation letter paragraphs. The first one where management tells us that they're not aware of actual, suspected, or alleged fraud. There are 3 things they have to talk about, so put those in the letter. And then say something like, and particularly in a small audit, our procedures are informal and involve close involvement of management. And that might be satisfactory in a small audit. In a larger audit with internal control, or internal audit rather, you might want to mention, internal audit, think about fraud, and do stuff about fraud. So as you're updating your rep letter, think about whether or not those 2 paragraphs are still appropriate, and management will sign it. Now, the other thing is, I don't like this choice on those charged with governance. It kind of wastes my time. And my conclusion is, rather than spending any time at all deciding whether I need to have those charged with governance sign, I'm just automatically going to do it. I'm going to have a board member sign, and I'm going to have management sign. Now, in a small audit with a single shareholder, board member and management are the same, fine. But in a smaller audit, a not-for-profit organization, those charged with governance and management are 2 different groups, so it would be very important in those circumstances to have a member of management, the executive director, depends who the most senior management person is, and a member of the board sign. And there are many circumstances where we have to think about this, and I'm not going to bother deciding. I'm just going to, if I think about it, I'm going to include those charged with governance, just because. So this is something that can be purely solved through standard documentation. Checklist prompt to make sure we've got those paragraphs in the rep letter, a standard rep letter, and we've taken care of that problem. Team planning meeting. I quote, "The auditor did not conduct a team planning meeting to discuss how and where the entity's financial statements might be susceptible to material misstatement due to fraud, including how fraud might occur. The engagement partner must be in attendance," and they refer to 24016. I kind of disagree with a couple of these things. You don't have to have a meeting. The discussion doesn't have to include how fraud might occur, though you might do that. And I think the engagement partner has to be more than just in attendance, more than just sitting quietly in the back of the room. So I don't quite like this paragraph. So what does 24016 actually say? Well, what it actually says is CAS 315, it refers to 315, requires a discussion among the engagement team members, not a meeting, a discussion, and a determination by the engagement partner of which matters are to be communicated to those team members not involved in the discussion. And that's exactly correct. So the report really doesn't properly refer to 24016. And 240 talks about fraud for sure, but not particularly 16. So let's go see what 315 says. Now the best reference I think is 315, and it is titled Engagement Team Discussion, not Meeting. And it says the engagement partner and other key engagement team members, so not everybody, shall discuss the application of the applicable financial reporting framework. So we got to talk about the financial reporting framework and the susceptibility of the financial statements to material misstatement. And material misstatement, whether due to fraud or error, is left unsaid. So it's a discussion, not a meeting, and there's two things that are to be discussed: the accounting framework and material misstatement. Paragraph 18 says when there are engagement team members not involved in the discussion, of course there won't, it would probably not be appropriate or necessary or practical to include everyone. The engagement partner shall determine which matters are to be communicated to those members. So it's very clear, 17 and 18, that it is the engagement partner that leads this process and leads the discussion, and it's the engagement partner that decides what gets communicated to who. Now it's clear that the partner must lead the, I put it in quotes, meeting or discussion, whatever you want to call it, however you want to do it. Now, discussions can happen at a meeting. Discussions can also happen in other ways. Email, for instance. A series of emails could result in a discussion. A meeting does not necessarily result in a discussion. If you have a meeting and someone stands up front and just drones through a bunch of stuff, that doesn't result in a discussion, and that doesn't satisfy what standards require. So I like to emphasize discussing, not meeting. And we've got to remember that the application of the accounting framework has to be part of the discussion too. So checklist prompts for both of those things. And the discussion is about material misstatement, and it doesn't say due to both fraud and error, though that's implicit. But we need to be thinking about material misstatement, however caused, and particularly material misstatement because of error, because rarely will we find fraud, and if we do uncover a fraud, we're probably only going to think it's an error. Management will go, oh, gee, we missed that, oops. And they will never say, and we did it on purpose to try to misstate the financial statement. So focusing on material misstatement due to error. So I'm assuming that what practice inspection has found here is there are some people that aren't doing this, and their suggestion is, okay, have a meeting. And that's a documentation solution, not a performance solution in my view, just having a meeting. But I suppose maybe that might not be a bad idea. My preference is follow the two things in 315, discussion, let the people not involved in the discussion in on it, and prepare some kind of document. and have a checklist prompt to remind you. So 315, 17, and 18 are really important, and planning is very, very, very important, and it must be led by the engagement partner. The biggest risk actually is not missing a material misstatement. The biggest risk is probably an inefficient audit. If the engagement partner is not leading the planning, staff are going to start adding procedure after procedure after procedure. And you're suddenly going to go, how come this audit is taking so long? Well, it's because the engagement partner didn't lead a planning discussion. The other thing standards point out is that in a small audit, the engagement partner might do it alone, might be a sole practitioner and not use staff at all. So the engagement partner could do the whole thing by themselves and then communicate it to others. That's fine. So checklist prompts are clearly needed. The emphasis on fraud, again, in the document, almost all the paragraphs they refer to are fraud paragraphs. And it's fraudulent financial reporting, material misstatement that we're concerned about. And as I said before, we don't care about finding fraud. Someone stealing pencils, that's fraud, that's theft. Theft is defined as fraud. We don't care. Office supplies inventory either isn't recorded or got counted at inventory or counted at year end. Somebody stole pencils, it's been adjusted. We don't care about that. So the discussions must be documented. 240-45 and 315-38 require it, and we must document that we did that and we considered all of those things, and we considered fraud and error at the same time. Simple solution. Now, some firms regularly have a meeting. Sometimes they do it without the partner. And what that really is, it's not a planning meeting. It's the meeting where you communicate what the partner and key team members decided to those who weren't involved in the discussion. Now that works, but it's documentation, not performance, and it makes a pretty file, and you may or may not need to do it. If you have produced an audit planning memo, if you have documented an assessment of risk of material misstatement by component by assertion, which you're required to do, if you developed audit programs, that tells the people not involved in the discussion what to do, but it makes a pretty file. Oh, look, we had a planning meeting. It takes a lot of time, but it makes a pretty file. It's a waste of time. And like I say, it's better done in other ways. Now, recommendation number 4 is about doing analytical procedures for material misstatement. And the reference they provide is 240-23, which is a fraud reference. And this is at the risk assessment phase. And analytical procedures are by far the best risk assessment procedures, and they certainly should be done and documented. I would prefer to look at 315-14B, which exactly requires what the report says. And 315 is about looking for material misstatement. 240 is only about looking for fraud. So it's a far smaller group of things that we're looking for. So I prefer 315-14. And the documentation here can be simple. I compared this year to last year and nothing was noted. Or I noted this and it's on this working paper and this is what we're going to do about it. We're at the planning phase here. We're at the risk assessment phase. We don't have the requirement of having an expectation to compare our analytical procedure to. If we want to get evidence, we got to do that. But this is risk assessment, so we don't need it. So 240-23 is not the best reference. And anyway, I think we can simply solve this through documentation. Number 5, failed to do audit work on material components. Really? This is a significant performance issue, and if you're skipping material components, or indeed any component, you probably should look at almost every component, even prepaids. But you set risk of material misstatement at negligible, do only a very small amount of audit work, and move on to the next component. So, significant performance issue. Need to fix your standard forms and checklists. Number 6, testing journal entries, adjusting journal entries. 220-33A. a very confusingly written paragraph, and one that a lot of people perhaps don't understand, and they respond with documentation, not performance, and not assessment of the risk of material misstatement. So the first requirement is ask individuals involved in the process about unusual adjusting journal entries. Automatic. Put that in the rep letter. We haven't observed any unusual journal entries. Automatic, every client. Have a checklist prompt. It's in the rep letter. Test some adjusting journal entries at year end. Well, how could we kind of not? We test property, plant, and equipment. We test accumulated depreciation. We take a look at allowance for doubtful accounts. Now, the first thing is, in a very small audit, maybe there are no adjusting journal entries at year end and no adjustments made in preparing the financial statements because the auditor does them all or recommends them all. So a checklist prompt to consider whether or not our audit has already required us to test year-end journal entries like depreciation or allowance for doubtful accounts or accruing accounts payable, whatever has to be done, because we probably have already done it. Or perhaps we did them all, and we just need to note that the only adjustments made in preparing the financial statements were done by us at the client's request. We recommended them, they approved them, and we're done. Number 3 is consider testing throughout the year. Now, some firms don't want to think about it. Just going to pick 3 a year, or 3 a month rather, test 36 entries all through the year. Bob's your uncle. Now, what happens though is we're looking for fraud here. These three things are directed at finding fraud. So if what we do is we say, okay, pick a journal entry in January, see it was approved by management, good, drive on. Well, we're worried about fraud committed by management, so seeing that management has approved it does no good. So if we're going to do this, we'd better do some procedure or other than just getting approved by management to make sure that it's right. That could be quite complicated. But it says consider testing at year end. So if you have a checklist step that says, I thought about it and decided not to, and I read paragraph A45 that said I could use my professional judgment, I'm going to say, well, thought about it, used professional judgment, decided I didn't need to. That's acceptable. Now, 330.20 requires testing a material year-end entry, so we have to do it anyway. So we automatically have to comply with number 2. So that should be just a checklist step. We followed 330.20. And how could you not if you audited the balances? So we need a checklist prompt for both, and this is solved through documentation. Number 7, did not audit accounting estimates. Really? The comment I just made about you have to audit significant year-end entries and not auditing significant financial statement items? Come on, a significant performance issue. And things like allowance for doubtful accounts, depreciation, those things like that, they're all for the planning discussion. We need checklist or audit program prompts, and we need risk assessment procedures. So, for instance, if we find that allowance for doubtful accounts is very small and always has been, and it's still small this year, perhaps a few very brief procedures are all that is needed. And the same with depreciation. Maybe analytically, we can roughly determine that it's roughly about right, materially correct, and we don't have to do much to audit it. But something has to be done. So, significant performance issue, make sure we have checklist or audit program prompts to audit all accounting estimates, somehow or other. Not necessarily a lot, but somehow or other. Number 8, the rep letter date, 5/80/14. Now, standards are kind of complicated. The rep letter can be dated, I don't know, shortly before, and I don't know what shortly before means. Is it a week? Is it a month? Is it a year? Is it 2 years? I don't know what shortly before means. Now, we draft them both. We are drafting the audit report and putting a date on it. We are drafting the rep letter and putting a date on it. So make them the same. Make it the same as the audit report date. Now, it certainly can't be after the audit report date, and apparently that's what people have been doing. So you've issued the audit report without required management representations, so you've clearly not met standards. But this is a documentation issue, and this is an issue we have inflicted upon ourselves. Now, in a very large audit, or in an audit where the financial statements have to be approved by the board, we are going to have to phone up the client and say, okay, when is the board meeting to approve the financial statements? And so then we can send them draft financial statements with the report date sometime in the future. We can send them a rep letter with the same date as the report, and then we sit and wait until we hear that they have approved the financial statements and have returned the rep letter, which would, by the way, also say that they'd approved the financial statements. So make it the same date, and this is solved through documentation. Have a checklist prompt to remind ourselves to make sure they're the same. Evaluate if error is due to fraud. This is a documentation deficiency. Said before, we are unlikely to recognize if an error is caused by fraud. It's very unlikely. And we really only care that we've got the error and got it corrected. If it happened to have been caused by fraud, we don't find that out. Oh well. So it's a documentation deficiency, and we need to have a checklist step that says, I considered whether or not, or evaluated whether or not error was due to fraud, concluded that I had no evidence that it was, tick, drive on, documentation problem. Assemble the file on a timely basis. Now this is a bit documentation and a bit performance. Now the reference should be to 230.14. They've referred to a fraud paragraph, not the correct paragraph. But in terms of performance, this should be done immediately. Now we technically have 60 days, and there's this reference in standards, but we send out the rep letter, we send out the draft financial statements, they come back. At that time, we have completed the file except for putting the final financial statements in and putting the rep letter in. So when those two documents come back, we issue the financial statements in proper form and put the final financial statements and the rep letter in the file, and we're done. So we need a documentation prompt to remind ourselves to do that. And if you wait a day, then it's 2 days, and then it's a week, and then it's a month, and then it's not until practice inspection shows up and we've got a rep letter sitting one place in our office and a set of final financial statements in another place and the file, and it's not complete. Do it right away. Now you can make changes afterwards if you need to. You just got to document what you did. And there are other requirements in 23 and 24. Make sure you follow them. This, by the way, is one of the places where standards suggest a checklist, a completion checklist, to remind us to do these things. So, and it actually says you don't have to have a completion checklist, but I prefer to do it to remind myself to do this, just to make sure I've done it. So that would be the last thing I would check off on the checklist, and then my checklist is done and I'm finished. Moving on to number 11, which is about review engagements. Now they wanted prettier documentation of the accounting systems. And I think we need a checklist prompt for this. And we don't have to get complicated. We can say they use the following accounting software, reconcile the bank monthly. That might be all we need. Maybe we need more, but that might be all we need. So we need a checklist prompt for that. Now what they said in their report was they wanted a reference in the file to the accounting standards used. Now my preference would be in a checklist to say the accounting standards are described in note 1 to the financial statements, and so we've got that already documented. So as I say, that should be in the accounting policy notes, so refer to that and we've got it documented. This is mostly a documentation issue. We have to pause and think whether we've got enough documented, depending on the size of the client. Maybe a bit more is needed or maybe not. Number 12, document where material misstatement is likely. I'm going to call this a performance issue because the whole new standard is written in the context of identifying where material misstatement is likely and then doing something about it. So of course that has to be done. But many times in review engagements, many times in small audits, the risk of material misstatement is often not above low, ever. And so often, maybe almost all the time in a review engagement, risk of material misstatement in an audit context is low. So material misstatement being likely is not applicable. Now we have to do something. We have to do a set of procedures that are unspecified in standards, which our own firm standards had better specify. But we got to do some stuff to contemplate whether or not material misstatement is likely. Have to do that. Now the other thing we got to remember is material misstatement being likely is pretty high. The dictionary definition, and there's not one in standards, but the dictionary definition of likely is reasonably probable to occur. Pretty high. Certainly higher than risk of material misstatement in an audit being moderate, which is 50%. Because that's kind of, could be high, could be low, right? Material misstatement being likely, I don't know, I'm probably wrong, 70, 80% chance of being wrong. That's pretty high, sets a very high standard, and often it's never going to be that high. So this is an important performance issue. Documentation can help, but it's got to be something we can do. My preference, though, is to say, I did all these procedures to assess whether or not material misstatement was likely, and I concluded that it wasn't likely anywhere. So I don't have to do any other stuff. So a simple checklist statement to document what I did, but it's a performance issue. Got to cover all items in a review engagement, and actually only have to cover material items and disclosures. And all we're doing is analytical procedures and inquiry. So that should be pretty simple. The problem is we only have to cover material items. So what that kind of requires is you to do another process of determining what the material items are that you cover and what the immaterial items are that you don't cover. And remember that cash, being a very small balance, still could be a material item because it really could be supposed to be a huge overdraft. So it's kind of an additional complex procedure to do. My preference is just do everything. We have to do some kind of procedures or other to determine where material misstatement is likely. So if we just cover everything, that solves it. Then we've done it. Now this is a performance issue, but again, documentation and approach can help. Number 14, a long list of items to discuss. Put them all on the standard rep letter. Checklist prompt is not a bad idea. Did we ask management about this? Yes, it's in the rep letter. Did we ask management about that? Yes, it's in the rep letter. So this is largely a documentation issue, or can be dealt with largely by documentation. But be sure to do it. Be sure to have all of those things in the standard rep letter and update it annually and make sure that we've had that discussion with management. Quality management, 15 and 16. Two really significant performance issues. Now, quality management process has been required since 2009, and apparently some people have not done it. Really, performance issue. Do it. Develop checklists, develop standard programs, develop something, and make sure you do it. Now, the second thing they observe is this was updated in 2019. 2019 seems like a long time ago now. Some people have not updated their forms. Some people have not updated their procedures. Really? Another significant performance issue. Read the standard, update your forms, update your checklist, update your programs, do it. Quality management. Now, in the good old days of 2009, all we had to include in quality management was audits and review engagements. The 2019 revision expanded that to include compilations and some other engagements. Now, my attitude in 2009 was that I can get into trouble, or my firm can get into trouble, with a compilation as easily as with a review or an audit. So I included compilations because I wanted to make sure that throughout the firm we were following standards and had a high standard of quality. So why wasn't this done before, and don't we care about quality, and why haven't we revised our standards in 2019 to include this? This is a performance deficiency. Pay attention to it. Number 18 and 19, engagement quality reviews. Now, this is something we have to be careful about. This is required for public companies. If you're a small firm, odds are you don't do any public companies. And it's for other entities that are similarly complex to public companies. Small firm, odds are you don't have anyone like that. So it is probably not applicable in a small firm. Now, what happens, though, is some people interpret this and say, well, we have some entities that are more complex than others. Now, they're still nowhere near close to as complex as a public company, but they go, oh, well, we'll decide we'll do an engagement quality review on our most complex client, even though it's not required. Now, the procedures and the things we have to do as specified in standards are appropriate for public companies. But if you try to apply them to a small firm, you'll go, not applicable, not applicable, not applicable, don't have quarterly statements, not applicable. So need to consider it and then document that we don't have any that require it. So this is a documentation once we understand it. We need to document and note that we thought about it, but we don't have any that need an engagement quality review. Second partner review is another way of understanding this. Don't need it. It's required for a company that is as complicated as a public company. 20, 21, and 22, compilations. 2 are significant performance deficiencies, and 1 which is actually in 2 parts, which is solved with documentation. Some people have apparently used the old report, and I forget when these standards were changed, but come on, use the proper new report. Some people have used the old standards and a checklist appropriate for the old standards. Come on, really, gotta use the new stuff. So update your forms and update your performance. Do it the right way. Now, the other thing standard setters have done that I think is only going to get us into trouble, and it obviously has, you're required to have an accounting policy note. And this is really complicated. And what some people did was they said, well, we use generally accepted accounting principles. If you're doing a compilation, you have done no work, you know nothing. You have no possible way of saying that they were using generally accepted accounting principles. So this is the accounting policy note, and beware the accounting policy note. It's point number 23. Now, we have done no work, so we have no idea if we're close to any of the forms of generally accepted accounting principles. There is obviously not a complete set of notes. We haven't done a statement of changes in financial position. So we have absolutely no idea what the accounting policies are. We don't know. We have no idea, and we have done no work. Now, here's a note that is consistent with the fact that we've done nothing. I'll let you contemplate what you might want to say, but this is a suggestion that you can adopt or not. First part I particularly like is, I don't think I want to say accounting policy note, because to some extent that might imply to a user that the external accountant was involved in that. And we're not. We've done nothing. So I want to say something like basis of accounting selected by management to make it clear that this is management, not the external accountant. And my first preference is to say management has selected the tax basis of accounting for the compiled financial information, because almost all the time, Only reason we're doing compiled financial statements is so the client can do their tax return, corporate or personal. And so the tax basis implies that depreciation came from the tax return, which implies to us that that's exactly what we should do for depreciation, not calculate some other kind of depreciation and then have to add it back and deduct the right amount. No need to mention accruals, and we've done nothing. Now, I sometimes wonder if we should say cash basis with certain accruals provided by management, but I think that's less clear. People understand the tax basis. It's appropriate for a tax return, and as long as we're satisfied that what we're doing is appropriate for the tax return, I think I like that best. But you have to have an accounting policy note, and it's got to be really clear that it's management and we had nothing to do with it. So 8 performance-related deficiencies. The rest are mostly documentation. So take the advice of standards and have a checklist to prompt all this stuff, and use a checklist to document as well. And you'll recall that as we went through this, there were several places where the checklist might have provided satisfactory documentation. Other times it's just a checklist prompt. I did it, and the documentation is on the following working paper. So that's a checklist prompt to where we've done and prepared documentation. So thanks for listening.